Welcome to this explainer. Now, when you think about insurance, I'm guessing your mind immediately goes straight to dry paperwork, endless contracts, and impossibly tiny fine print. But let me tell you, the actual history of this industry, it's nothing like that. It's actually a thrilling, centuries-long saga of human ambition, catastrophic disaster, and incredible survival. It is literally the story of how we, as a society, have tried to tame the unpredictable forces of the world around us.
So, to get us started, I want you to ponder this for a second. What exactly connects a tiny, smoke-filled coffee shop in London back in 1688 to an absolutely unprecedented $85 billion government bailout in 2008? I mean, it seems like a massive historical leap, right? How in the world do we go from guys drinking coffee by the river to the near collapse of the entire global financial system? Well, the answer lies in the evolution of how we manage risk.
Picture this. On one side, you've got a wooden sailing ship carrying valuable cargo across an unforgiving ocean. That is a very tangible, physical risk. But on the other side, you have complex global debt securities. These are completely abstract, systemic financial risks that you can't even see or touch. Over the next few minutes, we're going to trace exactly how the industry shifted from protecting that wooden ship to backing these invisible, highly complex financial instruments.
Part 1. The birth of risk.
You know, the industry didn't start out in towering glass skyscrapers. It actually began with what was arguably the most terrifying physical threat of the era, the open ocean. Back in February of 1688, a guy named Edward Lloyd opened up a little coffee shop by the Thames River in London. And it quickly became the absolute go-to spot for getting reliable shipping news and, crucially, marine insurance. Fast forward a bit to May 1721, and we see John Copson running the first known recorded advertisement for marine insurance in the American Weekly Mercury over in Philly. By 1792, a group of entrepreneurs actually got together in Independence Hall to create the Insurance Company of North America, writing their very first policy to cover a ship and its cargo. It's just amazing how rapidly this whole concept spread across the globe.
Part 2. Forging Through Fire. As towns and cities started booming, the unpredictable ocean wasn't the only massive threat anymore. Suddenly, fire became the next great challenge. The Hartford Fire Insurance Company, which was incorporated in 1810, began covering some truly monumental pieces of American history. In 1825, they wrote a fire policy for Yale University, the very first for an institution of higher learning. By 1859, they were selling a policy to Robert E. Lee to cover his Arlington home. And in 1861, Abraham Lincoln bought a policy to protect his own home and property in Springfield, Illinois. So even the most iconic figures of the 19th century recognized that one stray spark could literally wipe out everything they owned. $11.6 million. Just let that number sink in for a second. Following the absolutely devastating 1906 San Francisco earthquake, the Hartford paid out this massive sum in damage claims. It was the most of any insurance company involved in that disaster, and it perfectly captures the sheer, monumental scale of physical disaster recovery during the industrial age.
Part 3. Insuring the individual.
Now, as society modernized, we see a massive shift. It wasn't just about protecting physical property anymore. It became much more about protecting human life and dignity. In 1875, John Fairfield Dryden established the Prudential Friendly Society right out of a basement office in downtown Newark, New Jersey. And this was a huge democratization of the industry. For the first time in the U.S., life insurance was actually available to the working class. They pioneered something called industrial insurance, which was specifically designed to provide funeral and burial expenses for low-income families who otherwise just couldn't afford them. 3 cents. Some of Prudential's weekly premiums were literally as low as 3 pennies a week. I really want you to keep this tiny, super accessible number in the back of your head, especially when we get to those billion-dollar figures at the end of this explainer. Because this was an era where the primary goal was just ensuring that everyday working-class people had a basic safety net. And, you know, this concept of a community safety net empowered some monumental historical achievements. In 1898, pioneers John Merrick, Dr. Aaron McDuffie Moore, and Charles Clinton Spaulding established the North Carolina Mutual and Provident Insurance Company. It would go on to become the oldest and largest African-American life insurance company in the United States, providing absolutely vital economic protection and dignity during a deeply segregated era.
Part 4. Oddities and Innovations.
As the 19th century bled into the 20th, human behavior and technology were changing so fast that companies had to invent some pretty wild rules and unique policies just to keep up. Take 1851, for example. The first president of MassMutual, Caleb Rice, had some incredibly specific exclusions for life insurance. They absolutely would not insure you if you took ocean voyages, if you worked near those dangerous new steam engines, or, and get this, if you took summer vacations south of Virginia. It's a rapid-fire look at the terrifying frontiers of mid-19th century life, right? But hey, innovation moved at lightning speed. By 1888, Travelers Insurance issued the very first automobile policy to an individual, charging just an $11.25 premium for liability coverage. And then, just over 2 decades later, in 1920, the Hartford sold the highly specialized sickness policy to baseball legend Babe Ruth. This was specifically to protect his monumental earnings just in case he was unable to play. We really start to see the industry stretching to cover entirely new aspects of modern life. Now, here is a really fun, kind of surprising historical fact for you. 45 bucks. In 1963, a graphic artist named Harvey Ball was paid just $45 to invent a little yellow button. The goal was to cheer up employees during a rocky corporate merger at the State Mutual Life Assurance Company of America. That button? It was the iconic smiley face, a global cultural symbol literally born from an effort to boost morale at an insurance company, all for $45.
Part 5. The Casino in London.
All right, this is where our story takes a major dramatic turn. We're shifting from insuring tangible human risks and property to backing highly complex, completely abstract financial debt. The American International Group, or AIG, originated humbly enough in 1919. It actually started as a property casualty insurance agency in Shanghai, China, founded by an American named Cornelius van der Star. He was the first Westerner in Shanghai to sell insurance to the Chinese, and from those international roots, it steadily transformed over the decades into an absolute global behemoth under executives like Hank Greenberg. So, fast forward to the 2000s. A division of this behemoth started dealing heavily in something called credit default swaps. These were super esoteric financial contracts where AIG was basically acting as an insurer for investors who bought complex, risky debt securities. If the securities defaulted, AIG was effectively on the hook to cover all the losses. But here is the critical pivot. Because AIG boasted this pristine AAA credit rating, they considered this business largely risk-free. Actually, scratch that. They were so confident that they didn't even bother to build adequate capital reserves to cover potential major claims. And the sheer hubris of this era? It is perfectly captured in a 2007 quote from AIG executive Joseph Cassano, who oversaw the financial products division based out of their Mayfair, London office. He stated on record, "It is hard for us, without being flippant, to even see a scenario within any kind of realm of reason that would see us losing $1. I mean, wow. This statement was made right before the entire housing and financial market crashed.
$61.7 billion. On March 2, 2009, AIG reported a staggering $61.7 billion loss for their fourth quarter. It was, at the time, the biggest quarterly loss in corporate history, utterly shattering previous records. Because they couldn't pay their claims, institutional investors all around the world were instantly forced to reappraise the value of their securities, threatening a complete meltdown of the entire global financial system.
The fallout was completely unprecedented. In September 2008, the Federal Reserve agreed to an $85 billion bailout of AIG. This was the most radical intervention in private business in the central bank's history. I want you to juxtapose this colossal, almost unimaginable sum with the humble beginnings we started with, right? Think back to Edward Lloyd's coffee shop or those 3-cent weekly premiums meant to help low-income families bury their loved ones. The leap in scale and complexity here is just staggering. Which leaves us with this final, truly provocative thought to wrap up our explainer today. In a system that was originally built to protect us from physical disaster, who really bears the risk today? We've gone from building community safety nets and protecting wooden ships to governments bailing out multi-billion-dollar abstract financial bets. It entirely shifts how we view the modern financial machine, doesn't it? Thank you so much for joining me for this explainer, and I hope it makes you look at that fine print on your own policies just a little bit differently from now on.